Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
All right, excited to have another episode of Kiss My Assets. And I'm Jamison Manwaring, CEO of Neighborhood Ventures, and excited to have with us the other co-founder, John Kobierowski, in studio today. John runs real estate for Neighborhood Ventures and is also the founder and CEO of ABI Multifamily. ABI's the number one apartment broker in Arizona for like 5 years, and you also have offices throughout the Southwest. So we wanted to pull you in, John, and talk a bit about what we're seeing with the multifamily market, because you see so much in that space, and want to get kind of your high-level takeaways of some of the things you're seeing right now.
You know, when the markets are changing like this, we see so many things happening. We've got probably 20,000 apartment units, plus or minus, somewhere in construction planning, going to be delivered over the next 18 months.
Within the Phoenix Metro.
Yeah, correct. Phoenix Metro. And that's a lot, because we, in our peak times, we probably delivered 10,000, 11,000. A lot of things that are happening, especially with construction. We don't normally deliver this many units, but we need them. We need 277,000 units over the next 10 years. That's 27,000 units a year or more. We're not even getting close to building that. We never have. What's being delivered is probably, I'd say, 12 to 14,000 this year at tops, and then another 10 or 12 next year. So all these units won't get delivered next year. Supply chain issues, construction, manpower, all those things.
And some of these units were in backlogged from COVID delays, related delays, materials.
Yeah, if I had a whiteboard right here, I could show how there's a whole bunch of stuff working its way through the system that started up again with COVID. But then moving forward, nothing else is out there after COVID. Things didn't get started. Banks weren't lending as much. People worried about construction projects. So effectively, what we keep hearing, and our research people keep telling us, and I keep hearing over and over at conferences, is end of 2024, big drop off of what's going to be delivered.
Yeah, of new additional units, even though we continue to need 25,000, 27,000 just to keep up with the demand of the migration into Arizona, into the Phoenix Metro, because of the increase in interest rates and the changing environment. There's less new projects underway. And so what about the resale market? What are you seeing as far as number of transactions, values? Are people buying apartments right now?
Well, I heard it best. There was a little meme I saw about homes, and the guy, people are all like holding their homes in their arms. The idea was, why am I going to sell my house? I've got a 2.5% mortgage. I don't really need to move. I'm not selling. Same thing happening in multifamily right now. Transaction volume is down probably 75 to 80% year over year. Not that there's an issue with real estate. It's just that the owners that have the properties are saying, blue skies.
Why trade it?
We're full. Our rents are going up. The properties are doing great. Why am I going to sell? And if I sell, I've got to take on debt at the new higher rate. So why am I going to jump out of the pot into the fire? As my father said, don't jump out of the pot into the fire. So I don't know how that gets corrected, except for at some point we have to see lower interest rates. But sending single family homes, sales are down, people aren't moving. And, it's one of those interesting times where transaction volume is way down. We saw a chart that I sent you of Fannie Mae originations. I mean, the bar chart, 2021, 2022, 2023, it's like you can barely see the little green where it is. And then there's a little part that's like shaded with hash marks, and that's annualized based on first quarter. So it's a guess, and it's still like nothing. So yeah, it's going to be an interesting year. So what that means to me is opportunity, because we have a good market. We have good property. We know how to run it. And the one thing about us at Neighborhood Ventures is we have access to all that stuff because the people we know, our relationship with ABI, our banking relationships run deep. So we have relationships with the banks that are lending, and we're able to negotiate better deals on deals we're buying.
Yeah, and I want to get into the lending here in a minute too. what you're describing with the transactions when it comes to buying and selling apartments. Any real estate agent you talk to, mortgage broker you talk to, they're saying the same thing about houses. In fact, houses continue to hold their value, if not at least in many zip codes in Phoenix, they've started to creep back up. Now people are starting to get used to a 6.5% mortgage, and they still want to move, they still want to buy a house, and there's so little inventory because of what you described. We call it the sellers are on strike. They're saying, I'm not going to sell. I don't need to sell. And you can see that across single family and multifamily, kind of the same thing. So that, I think the big question around that is, how do values hold up with apartments? And what are you seeing when it comes to that? Are there a lot of distressed deals out there that people can buy that, apartment sellers are saying, hey, buy it on the cheap? What are you seeing when it comes to that?
Yeah. So for new people coming into our market that haven't been active in Phoenix as apartment buyers, their first question is, tell me about the distressed market. And my answer is, we don't have that. I'm not saying we can't get there if we have interest rates at this rate, at these heights going longer. Sure, there are going to be some people that can't refinance and fix their problem. But for the most part, people that have properties are doing fine and values are staying up. Now, Jamison, you understand there's a difference between actual value and paper value and what I call functional value. What is a property really worth to the market versus what is it worth to the owner versus what is it worth based on the cap rates in the market? Well, our cap rates have gone up. So on paper, effectively, our values should have gone down. The reality is no one has to sell. So we're not seeing values go down. And then we have rent increases, so we still have good occupancy. So we're actually chiseling away at that higher cap rate, and buildings that aren't selling, well, give it a year with rent increases and strong occupancy, and you almost ride right through that value change.
And that's kind of the psychology of getting into owning an apartment building, investing in an apartment building, that I think is interesting, because it's easy to get into the psychology as a homeowner. If you have a mortgage with a low fixed rate mortgage and you don't need to move, you're not going to move right now. It makes no sense to sell a home and pay 6.5% interest when you're at 2.5% or 3%. For an apartment owner, if you have a property that's generating strong income from rents and rents that are stable or moving up, the psychology is almost stronger to not want to sell,
right?
Because the new buyer who would be coming in would be paying a higher interest rate in today's environment. And now is a time to hold and to have those things be cash cows to take some of that money home. And we've seen rents in Phoenix in the first quarter increased, even after the big increases.
7.74%, the number I saw.
Yeah. And so, rents continue to be strong even after the big increases we saw in 2020, 2021, and 22 during COVID. Rents went up quite a bit along with inflation. So as an apartment owner, that's what you're looking at is as your cash flow from the rents versus your expenses, which may include your mortgage. So not seeing a lot of transactions. You mentioned debt, and that plays a big part of what happens with the multifamily market. You have to be able to borrow just like you would if you're buying a house or trying to sell a house. That person buying your house needs to get a loan. We've heard a lot about what's happening with regional banks. We know that regional banks do have some exposure to the office market, which is going to get is in the process of going through a revaluation right now.
Good way to put it. Yeah.
So what are we seeing as far as lending when it comes to multifamily?
Well, I'll step back on something. Luxury homes, metropolitan Phoenix, high-end homes, they're selling, and they're selling for cash. So people are coming in and buying that $3 million home and writing a check. In fact, I think I just saw the other day, one of the most expensive homes in Paradise Valley just sold for $23 million cash. So different mindset. But if you're looking at apartment buildings right now and you need to get a loan on your property, which most people do, we're losing options. And I say that not to scare people, but to say, be prepared. The bank that has lent to you before, the agency, Fannie, Freddie, HUD, things like that, they're out there, but they're changing their requirements. And the banks that we're lending, as you said, they're feeling a little bit of a credit crunch. They're keeping more cash available in case there's more of a pull on their deposits. I mean, I dare say that a lot of the banks have said, we can't lend on an apartment building or any kind of commercial real estate because we can't tie up cash for the next 5 or 10 years.
Well, we saw that with SVB, Silicon Valley Bank, they had a run on the bank. They had too much exposure to long-term treasuries that they needed to hold longer, and they ended up having to liquidate those early, and they got like half of the value. And so I think a lot of the banks looked at that and said, okay, we want to keep our money in more liquid assets. And commercial real estate in general, which includes office, multifamily, retail, is a longer duration hold.
It's an asset, safe, but
right.
But the banks take that and they take that loan and say, 20 million bucks we lent out, it's sitting there, it's paying out over the next 5 or 10 years. So it's a long-term investment for the bank. So that cash is tied up.
Because multifamily's housing, it has more options for lending than an office building.
Oh, and always.
And walk us through that. What are those options and why are they there?
Yeah, that's a good question. So if you own an office building, you've got to refinance it. There are very few options. Maybe a life company, maybe a CMBS loan. The small regional and national, regional, and small banks, those are kind of out of the business right now for lending on that stuff.
But they traditionally are the ones who you go to.
Those are the only ones. Multifamily always has lending because you have Fannie Mae, Freddie Mac, HUD, some other things out there. But those three lenders are always in the market. They're out there. They will not lend on an office building, a shopping center, a warehouse, but they can and will lend, and they have a directive to lend on housing, multifamily.
That was another advantage to owning multifamily, to investing in multifamily, is as these lending options tighten up, and we're starting to see that, and that won't last forever, but
right.
We're going through that transition. There is still that backstop of these government-sponsored agencies that will do this agency sort of debt, and that's just kind of the nature where we're at right now. It's an interesting market. We think it's important to discuss and be transparent about the goods and the bads. And as you alluded to before, we see this as an opportunity because we have a good understanding of the market. We are not sitting on the sidelines, not purchasing right now. And maybe you can talk a bit about why we want to be opportunistic over the next year to 18 months and continue to purchase property right now.
So I'll start off again saying that we have good banking relationships, whether it is the few banks that are lending, bridge lenders, construction lenders, stuff like that. Thanks to our investors, we can raise capital quickly. That's another advantage. But I'd say that most of the competition right now to buy those buildings, the few that come on the market, they don't have those. So they can't get financing and they can't raise the capital.
Yep.
In fact, a lot of them are still trying to fix and rebalance their current portfolio and current properties where we're like, we've always gone
stuff
on things,
they've bought the last few years.
We bought things right loan to right LTV on these properties and had a good plan in place. Some of these other folks right now don't have that option. So
and they're the ones that may have to sell. That we have seen a few properties come on the market that are good properties that they probably don't want to sell. If we owned them, we wouldn't want to sell them right now, but they may end up having to sell them, and they could be good opportunities for
especially in that midsection, what I'd call anything above a single family home loan. So anything you can get with a fourplex loan, that there's a dead area between that and, let's say, the Fannie Mae small balance sheet loan, 3 to 5 million, probably more like a $5 million loan. So that whole space in that area, it's very difficult right now to finance, but that's opportunity for us. We can come in, make strong offers. We're not going to undercut somebody. We're going to make an offer based on what we think makes sense, and we can execute on the offer and close it. I don't think there's a lot of other buyers out there right now that can do that effectively.
And we do have to think long term. Real estate is something that does really well long term. You can make some money short term, but if you have a long term view, it's even better. And if I look out the next 10 or 15 years in a market like Phoenix, and I think what's going to continue to happen here, I think values of property are going to continue to move up. And if there's an opportunity like right now over this next period to buy some good assets, hold them and get them at a better price than we could get in a few years, we're going to be real happy we did that later.
Especially in light of the fact that what goes up has to come down. I'm talking about interest rates. We know the only reason why interest rates are up, it didn't happen organically. It didn't happen because the market pushed them up. It was because the Federal Reserve pushed the rates up to 5.5. They did 6. How many times did they change it now?
Yeah, I think it's 10. The last 10 or 11 times over
10,
a year. Yeah,
10 or 11 times they moved it up. They just keep turning the valve
5%.
Off, and that's the only thing that's changed between last year and today. is that the Federal Reserve has cranked up the federal lending rate, which is causing the cost for money lending to go up.
Yeah, and we know that they're doing that to cool the market intentionally, and that they can't do that forever. And they've indicated that, and so I look at it as an opportunity. I know you do also, and we're going to continue to be players in the market, look for the right deals, have a lot of scrutiny on the
Well, they have to make sense today.
Yep.
But we know when the rates start coming down, I'm not talking about they don't have to go down to 2% or 3% again, but when they come down, we are going to start looking very, very smart when those properties are cash flowing because we bought them right. They were making money ahead of time before the things changed. And now that we have a lower interest rate environment, we're going to make even more money, and everything else goes up. Construction costs, maintenance costs, insurance costs, property taxes. So cost of replacement costs on a property nowadays, you got to put that in perspective. It costs a whole lot more to deliver a new property now than it did last year or the year before. It's going to order in 2 years from now.
I think a real simple example is if you can buy a building right now that makes sense at a 6.5% interest rate and it's still cash flowing, and you can hold on to that and refinance it at a 4% interest rate in a few years. That's the real opportunity. It's that simple.
You've got the operations stabilized, and you've had 2 years of rent increases. Yeah. So let's just use conservatively 7% rent increases. You've had 2 years of 7% rent increases. You had 14% jump in rents in that time period also.
Yeah, and then a significant deduction in your costs, in your debt costs.
Correct.
So that's our perspective. Great to get your pulse because of all the things that you see. We won't get into the conversation you had with a friend at a beer last night and a burger, but those are the conversations that actually bring a lot of insights as you're talking to people in the market. But those insights are valuable as you bring it all together.
Especially when you talk to people from different types of businesses and you see what they're doing, and you're going, "Wow, I didn't realize this was impacting that you're doing so much." Yeah.
Yep.